Hello and welcome to the cnbc TV 80 Clutter Breakers, where we cut through the noise and help you make sense of the news with in-depth analysis. This is your guide to navigate the uncertain environment, and we attempt to help you make smart investment choices. Before we begin, let me make it clear that what you're about to see are not stock recommendations. The idea is to turn the spotlight on interesting developments and trends so that you, the viewer, get actionable information to make informed choices. Over the last couple of weeks, we've started the show with multi-bagger stocks that have provided bumper returns in the last decade or so. Today, we start with the wealth destroyers, stocks that have fallen off a cliff and never recovered. Anuj is here with Off the Charts.
The stock market can be rewarding when in right stocks, but brutal when in wrong stocks. Today, we look at some of the biggest wealth destroyers of 2010 to 2020. Now, we are only taking wealth destroyers of this decade and hence are leaving out some of the other notable names like Suzlon, Punj Lloyd and the ADAG pack, which were of course the wealth destroyers of last decade. Look at these stocks. Yes Bank, which has destroyed wealth by 99%, DHFL by 99% as well, Jet Airways 99%, CG Power 99%, Jain Irrigation, Syntex, Balapur Industries, McLeod Russell, everyone destroying wealth by 99%. Now, one look at the shareholding pattern of these companies will reveal a very painful truth, which is that the retail shareholder ends up owning most of this junk while the big players exit when the trouble starts. Let's look at Jain Irrigation shareholding, for example. The promoter's stake is down from 31% to 28%. But look at what mutual funds and FIs have done. Mutual funds down to zero, FIs stake down from well over 50% to 9.7%. The retailers have gone up from here to 55%. That's the same story which plays out in Syntex. From owning only about 8% at the peak, retail now owns 84%. FIs down to zero, mutual funds down to zero, promoters down to 4.6%. Another worthless stock is Built, and it's an action replay. Retailers from 9%, look at how it goes up to 31%. Mutual funds down to zero, FIs down to 3.7%. McLeod Russell, similar story. Retail and promoters, look at promoters coming down, retail moving up to 57%, FIs down to almost nothing, mutual funds down to nothing. So what are the main factors that led to the wealth destruction in some of these stocks? You will find that the company will fall in any or some or perhaps all of these categories. They include costly acquisitions, mindless diversification, too much debt, intercorporate issues or alleged siphoning, and not adapting to changes in business environment. Let's get into details. The common poison among all these companies is debt. In most cases, the debt burden is so huge that the company cannot even pay the interest from the earnings. Forget about repaying the principal. CG Power last year did EBITDA of 103 crores, but paid an interest of 281 crores. Jain Irrigation made 34 crores at EBITDA level, but paid interest of 688 crores. It's the same across the board. The Avanta Group is a prime example of mindless acquisition or diversification. At its prowess, the Avanta Group was valued at nearly $4 billion. And that's when both CG Power and Built started to buy companies left, right, and center. In fact, CG Power made 10 acquisitions, and Built also made a large acquisition. Most of these acquisitions were funded via debt, and most of them failed to take off. Then there is the issue of intercorporate loans or diversion of funds. McLeod Russell, till date, remains India's biggest tea company, but is a big wealth destroyer. It's a company where business always remained strong, but one wrong bet of the promoters on McNally Bharat took the entire group down. There was an issue of large intercorporate debt as well of about 2,800 crores, for which the lenders have taken the company to court. And finally, sometimes you just fail to adapt to changing business realities. Syntex is a household name. We see their water tanks everywhere. But they try to create value by demerging plastics and textile business, but both businesses failed miserably. Jain Irrigation was one of India's marquee irrigation companies with some blue chip investors, but somehow could never manage its debt and receivables. This brings me to the most important point. When do you realize that you might be stuck in one of the wealth destroyers, and are there any signs to get out? For starters, one needs to learn to take losses in stocks and cut them off brutally. Look for these signs when it's accompanied by a fall in share price. Has there been a royalty or loan to promoter-owned group entities? Is the company facing huge debt and adding to it? Is the promoter selling stake in the market at every interval? Is there a large amount of promoter pledge which is just not being addressed? And finally, are the smart investors, that is FIIs and mutual fund selling, which is being lapped up by retail. Because like it or hate it, some investors will always have an information arbitrage or will be willing to cut the losses and move on. And remember, the first rule in making money in stock market is to not lose your capital. And second rule is to remember rule number 1.
Well, we hope that everyone does remember rule number 1. Anuj, many thanks for joining us. Now, successive rate cuts over the last few months have left India's key policy rate at a record low. This means interest rates for home loans have never been cheaper. So who is offering the best rates, and will banks see higher credit offtake as we enter the festive season? Ritu Singh sizes up the market.
Home loan rates have never looked this attractive in India. The current rates being offered by banks are some of the lowest that we've seen in a long time. Look at how rates have moved historically, and we're looking at the two of the largest players in the home loan market, State Bank of India and HDFC's rates. From a high of 10.7% in 2011, they've crashed all the way to 6.9% now, more than 4% lower through various regimes of base rate, then MCLR linked, and now repo linked rates. Now cut to the present, and if you were to take a home loan today, you could get it for as cheap as 6.7% from Union Bank of India, which is for the category of women borrowers with a good CIBIL score who are also salaried. Bank of India at 6.85%, State Bank of India, HDFC and Axis Bank starting at 6.9%, ICICI Bank, Kotak Mahindra, Bank of Baroda not too far behind, and Yes Bank is an exception, slightly higher rates here. Now let's also look at some of the offers on home loans by the largest banks. State Bank of India has waived off the processing fee. It's offering discounts of 5 to 10 basis points depending on what app you're using. HDFC Limited, the monsoon bonanza and special offers of loans of up to 90%. ICICI Bank is also processing fees for those home loans start at about 3,000 plus GST. Bank of Baroda similarly has waived off the processing fee and is offering lower rates for the festive seasons. Now, while this does look tempting, here's a few things you should keep in mind if you are considering taking a home loan. First is compare all of the interest rates available to find the cheapest option for you in terms of rates, the types of loan schemes that are available and best suited to you. Look at the fine print to make sure you see all the terms and conditions to avoid any unwarranted surprises in the future. Look at all of the fees that are attached, the documentation fee, processing charges, late payment, prepayment, legal fees, so on and so forth. And lastly, do consult your tax expert or your chartered accountant to make sure you can get all the tax benefits that are available to you on your home loan. You can claim up to 2 lakhs tax exemption for the interest component and 1.5 lakh on the principal amount and so on under the current IT rules. Now onto the factors that will influence the kind of rates the banks finally offer you. The first and the most important thing that they look at is your credit score. Now banks always look at credit score when you are applying for a loan, because if you had a good credit history with no defaults, you are more likely to get a better rate from the bank versus another customer who may have a bad track record. Second, a stable high income is rewarded with a lower interest rate because banks perceive a lower risk of default for this category. Third, the employment type also matter. Typically, you will see salaried applicants do get slightly lower rates compared to self-employed. Fourth, interest rates also depend on the size of the loan that you take. Fifth, the more money you are able to pay upfront as down payment, the lower your EMI can be. And lastly, you can look at the type of loan, fixed or floating rate loan. Typically, floating rates tend to be lower than the fixed rates on average is what we've seen. Now, why are we talking about home loans in the current context? Well, historically, if you see, home buying is the favorite tool used by policymakers to rev up the economy for several reasons. For one, everyone wants to own a home and will take loans if affordable. And second, the housing sector has linkages to several others like steel, cement and what have you, and therefore they have a multiplier effect triggering the growth of other sectors along with it. Now this also assumes significance because credit growth is languishing at a little over 5%, and therefore banks are doing all that they can to lure customers amid this festive season, not just with home loans but other segments as well. But will the customers sign the dotted line? We'll find out soon enough.
Well, Ritu, many thanks. From home loans to the business of banking, how does a bank make money? What are the parameters one must keep track of to keep an eye on the financial health of a bank? As we look at the rising NPAs and the fear of even more NPAs, Abhishek Kothari explains.
banks are in the business of borrowing and lending. Is it that simple? Let's understand. A bank gives out loan to, businesses and individuals, which are called as advances, on which it charges interest. It also earns interest on investment in government securities and corporate debt instruments. Let me tell you that, banks have to mandatorily hold about 18% of their deposits in GSEC or government securities. The earnings from all these items is called the core interest income for a bank. Beside this, the bank also makes income in the form of fee income, forex income, commission and recoveries from return of loans, which forms part of other income. So this is one part of the picture wherein the bank earns income. At the other end, bank also needs to get the funds in order to lend. So, banks get in money in the form of deposits, current account, saving account, fixed deposits on which it pays varying amount of interest known as cost of deposits. And they also borrow from other banks and institutions through various instruments like, certificate of deposits, etc., wherein they have to pay interest over there as well, known as the cost of borrowing. Put these two together, the cost of deposits as well as the cost of borrowing, it forms the total cost of funds for a bank. So net interest income is a term that you often hear. What is net interest income? It is nothing but the difference between the core interest income of a bank and the total interest expenses. From the net interest income, if you add the other income and deduct the operating expenses like employee expenses and the other overheads of running a bank, its branches, etc., we arrive at nothing but pre-provisioning profit. So from this, you must deduct provisions and taxes in order to arrive at the net profit or net loss for a bank. The provision is a crucial part. Provisions for NPAs include provisions for non-performing assets or loans that are overdue for 90 days or more, which are nothing but slippages, aging of NPAs and any other stress assets on which a bank intends to create provision buffer, like right now they did in the last 2 quarters for loans under moratorium. There's also mandated small provisions required for good and standard loans which are being repaid on time. About 0.4% is the rate. There is yet another provision that banks need to make, and that is to account for the change in market prices of the bonds and securities that they hold in their investment portfolio. So if the market prices fall below the cost, a provision over there is required to be made, known as mark-to-market losses, and an increase in prices can translate into a provision write back. Hence, a bank that makes healthy margins, anything above 3% is good, keeps a tight control on its operating expenses. So, a cost to income ratio of 40-45% is good, loses less on default loans. A credit cost of anything below 2% in current environment will be more profitable.
Well, Abhishek, many thanks there for helping us understand the business of banking. But up next, a deep dive into India's FMCG sector as we hunt for value. Mangalam will join us after the break. Welcome back. You're watching the cnbc TV 18 Clutter Breakers. Fast-moving consumer goods, or FMCG, is a key pillar of India's consumption story. FMCG stocks have been star performers on Dalal Street over the last couple of decades. But are the current valuations high? Mangalam is here with the FMCG deep dive. Mangalam.
It's the great Indian consumer story, the FMCG sector, which is the 4th largest in the Indian economy with a potential market size of almost 7.5 lakh crores. In this, the products that you and I use daily, household, personal care and food and beverages, account for nearly 70% of the industry. In the past, people's increasing purchasing power and increased availability of these products have been the key growth drivers, and these stocks have been D-Street darlings. If you take a look at it, over the last 10 years, we've seen stellar returns, and these stellar returns have actually come by over the last 2 to 3 decades itself. Even underperformers have risen 50% in the last 10 years. We have a handful of reasons for why these stocks have been D-Street darlings. The biggest one, of course, is the fact that there is a large addressable market. Buy what you can touch and feel, said Peter Lynch. Apart from that, there is relatively low capex versus other industries and negative working capital cycle, people getting money before they spend it. All of this obviously reduces the need for any further dilution and leads to higher return ratios, strong balance sheets. Less requirement for cash for daily needs also means that these companies have good regular dividend payouts, but above all these companies boast of extremely high quality, high pedigreed Indian as well as foreign promoters with great corporate governance and management history. Let's talk about the skyscrapers now. The ROE profile for stocks over the last 10 years. On an average, Hindustan Unilever has returned 83% in terms of return on equity. All the other stocks anywhere between 30 to 50%. Now let's talk about the key growth opportunities. The biggest one, of course, is the fact that major categories currently at a granular level still have just 2 to 3 leaders. So more leaders emerging would be a big opportunity. The second one, new growth categories, the likes of men's grooming, etc., would also lead to some growth. Bolt-on acquisitions, like I said, strong balance sheets. So can these companies go ahead and take on good companies and grow them? The likes of HUL acquiring Horlicks as well as Indulekha, ITC acquiring Savlon. It's believed that the next leg of growth for this sector will come from balance sheets, not just the income statement. And the big trigger is also increasing rural income, which currently accounts for just less than a third of the overall market. As rural income increases, demand increases, it could bring another field of opportunity for these companies. But like they say, no good thing comes at a cheap price. And the sector has been notorious for its high PE, because over the last few years, we've seen all these stocks trade anywhere between 40 to 60 times. So to prevent oneself from the risk of entering these stocks at extremely high levels, experts usually suggest a systematic investment plan or buying on dips in these stocks. So SIPs and dips, that's the key for the FMCG sector.
Mangalam, many thanks. And finally, this week, we demystify CAGR, or compounded annual growth rate. What does it mean and why is it significant? Sumaira is here to explain.
Warren Buffett famously said, "You're sitting under a tree today because somebody planted a seed a long time ago." Einstein called compounding the 8th wonder of the world. And that's really how important compounding is. And how do you measure it? Through the CAGR, or the compounded annual growth rate. As the name suggests, it's the annual rate at which your money has compounded between any 2 dates. So consider an investor who invested 100 rupees in 2010, and that investment is now worth 200 in 2020. So absolute returns for that investor is actually 100% in 10 years. So he has earned 100 rupees on an investment of 100. On the other hand, the CAGR returns is 7.18% per annum. This signifies that the investor's money has compounded at a growth rate of 7.18% per year for a period of 10 years to be worth 200 rupees in 2010. So, what may seem very attractive as 100% returns in absolute terms is actually a very low annual growth rate of only a little over 7%. So CAGR actually smoothens out all the short-term variations, and this helps investors to get a clear idea about the performance of a company due to its internal structure. But the application is not only to check the past returns. You can actually use CAGR to calculate the future potential too. Ashish Shankar of Motilal Oswal Private Wealth Management gives us this easy rule of thumb.
Rule of 72 tells you how much time does it take to double your investment. So to give you one example, if your returns are 15% compounded, that is CAGR, the question you asked, compounded annual growth rate, then an investment will take 5 years to double. But in 10 years, your investment doesn't become 3 times, it becomes 4 times, right? And in 20 years, it becomes 16 times. So that's the power of CAGR, and that's the power of compounded annual growth rate. So I think all returns should be measured in terms of compounded annual growth rate. Otherwise, it is incomplete. If somebody doubles his money in 10 years, you've got only 7% CAGR. If someone doubles that same money in 3 years, you've got 24% CAGR. And it makes a world of difference how your money multiplies into the future.
Well, it does make a world of difference. Also, there is the fact that CAGR does not reflect the volatility of a security trading in the stock market. And experts actually suggest that for this reason, individuals might not get a very clear idea regarding the performance in case of extreme fluctuations that occur. Other technical tools should also be used simultaneously to help make accurate predictions.
Well, Sumaira, many thanks for taking us through Market Simplified. That's it then on this edition of Clutter Breakers. Do log on to our website, cnbctv18.com, for more in-depth analysis. You'll find all of these reports and videos there, so you can catch up with them at leisure. With that, for this week, goodbye. Many thanks for watching. Stay tuned to CNBC TV 18. The news will continue.